All right, when we get started shortly, welcome everybody to our first investor webinar for our Grocers Warehouse. I'm sure people will be trickling in. We have a few updates for everybody, and I really want this to be also interactive. So feel free to ask questions on chat, or if I'm not sure exactly if you can ask anybody else, maybe raise a hand. Um, I first want to say thanks everybody for investing with us. Uh, we have been working pretty hard on this one for the last quarter, and hopefully, this is the type of update that you can come to expect. And if you guys have any feedback, please do give us that. We'd love to accommodate anything that we might be missing or anything we might be overlooking that you guys might want visibility into. With that, I want to start with sort of the content. So we're going to start with residential leasing updates, commercial leasing updates, and then we're going to go to budget tracking and development updates. And finally, just if you have time, looking at some potential new deals that Tozy Capital is working on. Uh, and I'll pass it to one of our general partners, Travis Gibson, to give us residential leasing updates.
Thanks, Annie. On the residential side, currently all of our residential units are currently fully occupied. However, we do have two upcoming vacancies this month. We're working with AMG, the property management firm, on the residential side, and they are in the process of touring prospective tenants. And we expect to have these vacancies filled in pretty short order. The property itself shows super well, and just the whole park environment it's really beautiful. So I don't expect any problems getting those units filled. In addition, AMG is implemented a referral program for the tenants, and we believe that'll really help drive better retention for our tenant base. So far as updates on the units themselves, we completed the kitchen upgrades on the studio units, and based on that, we were able to sign a 5-year lease on two of the studio units with Owl Stays, which is an Airbnb agency. That's a really amazing opportunity for us to lock in a very long-term steady rent, and really eliminates the expenses for managing the property, managing those units, as well as managing the expenses related to turnover. It really creates a win-win deal for us, as well as for them. And the other thing to keep in mind is even though we have a 5-year lease, we have an escalator in place where we are increasing rents year over year to keep pace with rent growth in KC. And yeah, that's pretty much it for right now. Residential is going really well, and I will hand it back.
Hey, Travis. Residential is really the bright spot here. We were projecting 21% vacancies with the expectation that we're going to really clear probably 5 to 10% economic vacancy. So I think we're on track to really make a lot of incremental revenue based on the residential side of things. Moving on to commercial, and I'll take the rest of the slides from now. So commercial, we've had two good news. One, Resin River signed a 3-year lease in the extra space that were previously an empty shell building that was empty storage that was meant to be a residential storage facility. And it wasn't locked. It didn't have any income as well. And very few people were actually using it. So we actually then repurposed the space for an existing tenant that just signed on as we were taking over the building. AMG placed that tenant in the residential loft, and they wanted to potentially open their own little business, Resin River, which is, if you ever seen those river tables, it's a really cool concept. and I think he has some pretty cool art and design as well. So he signed on a 3 year lease with us, and with the expectation, hopefully, that he also lives with us for 3 years. So that's going to be really cool to lock that in. So that's really all incremental revenue. We paid around $8,000 in TI to lock him in for around $32,000 in incremental rent. Um, Another good news is Rising Sun Solar is signed with us for the warehouse space and hopefully soon upcoming office space. So as you guys were familiar with when we were showing you guys this opportunity, we expected Rising Sun to actually sign with us earlier. Unfortunately, they backed out due to warehouse space requirements, and they had that option. And because they didn't, they took that option. Half the sellers actually lowered the purchase price by $24,000. And now, when we are now going to sign them, we don't have to pay back the $24,000. So this is really a win-win-win for everybody, or except for maybe the sellers. Um, uh, but for us, we were able to sign Rising Sun because we were able to ask Mediahead, which is one of our concerning tenants, and was always the concerning tenant of all the bunch, because of their business with media and print. It's something that is hit very hard during this time. And they have a very sizable rent expenditure with this space. So we were able to convince them to help us give us 600 warehouse space, and Rising Sun liked that space and they liked the office space as well. Can you go next slide? So I don't have control of the, so I'm gonna keep saying next slide. Um, so this was the floor plan that was presented to us when we first looked at the building probably a year ago. And so this has a couple of the tenant spaces and media head spaces. I'm going to go dive into each one building individually and talk about the story of what's going on with leasing. Next slide, please. So with the Huff building, and I call it the Huff building, that's where the primary are taking a lot of space there. So there are 4 available spaces. And the one middle space, 2970, is the one that Rising Sun was very interested in. And because it's essentially an empty shell, we would need to place around $60,000. And they actually had around $85,000 worth of TI, tenant improvements, to make it habitable for them. That included building out a kitchen, a cubicles, office, and so on. So uh, it from that perspective of investment, it would have generated another $300,000 of incremental rent. So that was a great ROI. But we're last minute, literally yesterday, I'm talking to AMG, and I haven't even told the other team members here yet. I'm asking them to see if we can get them on Mediahead's office space that they're struggling to pay. Can you go next slide, please? So Mediahead has all that space there in not Pierce and not private storage, which is actually the art collection by Bill Gotro. And he's kindly lending us, continue to lend us around $10 million worth of art on the walls. And no one, we haven't had any issues with those art. In fact, tenants really appreciate the art there. We've had some really good feedback. So they can't afford, Mediahead can't afford all the space, and they're struggling to pay rent. In fact, right now they're behind on rent collections, and that's something that we are sensitive to, but we're not necessarily giving them any allowance to reduce the rent at this point. We're hoping that they can catch up. We're hoping that the business can get better, and we're also hoping that they can come to a size and a rent expense that is more more amenable for them. And so we went ahead and helped them out and tried to lease out this 2945 square foot office space. And yesterday we showed this to Rising Sun. And because this office space is already built out, it has cubicles, it has a kitchen, It has all the stuff that they need, and their solar that's being stored is actually in this building. So it's just a little quick walk to their solar panels. Uh, they would be potentially interested. And for our perspective, there were some pros and cons to placing them in the other building versus this building. The the con is we're not really getting too much net income. If we place them in the other building, we would have gotten net income right away. If we place them in this building, we're really helping Media Head out and not and potentially saving us a lot of headaches when they potentially have to leave in April of 2021. So their lease is coming up the soonest. Pure is actually doing really well. They're all paying in time. All the other businesses are paying in time. They're paying cams. They're paying everything on time. Media is really the big sore thumb for us. And so for Rising Sun, we're trying to figure out if we can get them into this space pretty quickly because they want to come in by November with limited TI, so less expense, and because they want a more traditional office space with traditional cubicles, traditional refrigeration and kitchen. The other spaces which are more blank walls, might be actually better suited for other types of tenants. Now, unfortunately, NZG, which is who we're working with right now, hasn't delivered on their leasing. And while they came highly recommended, we are evaluating other options to find a new leasing agent to help us lease the building. But how we're tracking to everything is really we were planning. And can you go back to the previous slide? The previous slide. Sorry, I don't have control. We were planning that none of these spaces available were going to be leased out this year for 12 months. Not just this year, but for 12 months since next June. So that gave us a lot of buffer to to run with given COVID. I am still disappointed that we haven't leased them. I make my disappointment known to them, as my partners can attest, and uh, and I'm looking at some other options. I'm a pretty harsh critic when we don't make money for our investors. Um, Resin River was actually AMG a referral. Rising Sun was me calling up and signing up for their portal and making a call and asking about solar, and then saying, "Oh yeah, hey, I own Grocers Warehouse. Would you like to tour again? Because we're going to give you a little bit of extra deal from what last time. Because now we're actually not having to pay any leasing costs to NZG because we wrote them off as part of the exclusivity. Basically, that means that for any new leases that we would have found, they would have gotten a 33% referral fee regardless. They would have gotten the full 6% if they found it themselves. And I would love for them to find some tenants for us. And they've had some near misses, some gyms, some art space. I am going to go to Kansas City, and the partners I got in Kansas City a few weeks ago. I'm going to go again in 2 weeks, and we're going to tour the building with some other potential leasing agents, and we're hopefully going to find some good tenants for this building. It's a very unique space. It's not in the city center. It's in a park. It's really ideally suited for the local residents here, and I think there's a lot of great potential here. Next slide, please. So that's leasing updates. Hopefully, we get media heads sort of figured out soon. I would like the ideal situation that comes out of the next week, because this is literally happening real time. I called AMG on Friday to come with this new proposal. I had Keith, the CEO of Rising Sun, go yesterday morning, and then I talked to AMG again yesterday afternoon, and that's why this wasn't included last month's update. And the ideal solution here, in my mind, is we get Rising Sun in that space for $12 per square foot. Right now, they're being rented for 11. So now we're getting at least a little bit net one more dollar per square foot. We're also going to sign them for 5 years, and that's going to generate obviously more certainty. And we renew um, we renewed Mediahead to an extended 5-year lease at a lower rate, at a lower space that they can handle. And in fact, I'm also going to ask them for more storage space, warehouse space to give to Rising Sun because they actually want more space. So that's the leasing updates. So let's go to numbers. Um, let's talk about budget tracking, and I haven't provided these in our monthly updates, but potentially I might be soon. Uh, so we have budget until August month ending, so we don't have September yet. This typically the case with AMG. We don't typically get it until a month later from the last month. So this is only 2.5 months. So while I can say I'm hopeful this is what we track for, there will be some variance and some bumpiness. And let me walk through each one. So rent to revenue. One of the reasons why our budget rent to revenue was low is because of the 21% vacancy that I factored in. We don't have 21% vacancy. So we're up 16% year on year on a 2.5 month basis. Our expense recoveries are down significantly though. And that's because we also had a significantly less expenses. So if you don't have expenses, you can't recover. I should probably just net them out maybe next time, make it a little easier. But with effective gross income is down 6% versus budget, although if you look at the total expenses, it's down 19%. So we're really doing a great job of reducing our expenses. Taxes, we're putting into a little budget, so I'm not saying that's going to change, although we're still going to be fighting when we do get a tax bill. I fought every tax bill that I own, and I'm not gonna sit and take whatever tax they give us. We own a lot of I own a lot of stuff in Kansas City, and I gotten a few of them reduced by 30 to 40%. Insurance, that's something that I prepaid upfront, and I got a significant discount on. And so we paid $18,000, and our budget was around $22,000. So we're saving around 21%, although all that cost was upfront. So I'm just putting it as a monthly to show you how we're showing two variants. CAM, and I'm not breaking out versus CAM, repairs, maintenance, utilities, admin, although maybe next time I might. But essentially, CAM is common area maintenance. Repairs and maintenance is turnover and any of landscaping, other repairs. We haven't had any major repairs and maintenance. I do expect next year to have more. There is a significant concrete issue that would likely cost $15,000 to $20,000. Our plan is to have more tenants in that have triple net leases, and they help pay for those CAMs. And because the life of our concrete floors are still good, although another few snowstorms can make it a little bit worse. We haven't had any tenant complaints yet, so we're going to save that for next year, hopefully when we get more tenants in. Utilities is tracking fine. Admins, I'm actually adding a cost there that's one time. That's the cost segregation cost. And I don't have projections for that yet, but we'll provide that in the next update. And property management is tracking just perfectly. And leasing expenses is tracking lower, and that's a bit, that's not necessarily something that I like. I would actually rather pay more for leasing because that means that we're getting more leases. So I actually hope that we get more leases in this future. I'm projecting, hopefully that we get more leases in this year. So everything else is looking good in terms of total expenses. We're down 19%. And so our operating cash flow is up 36%, and our cash and cash are tracking around 12.8%. So that's project level cash and cash. And due to these financial reasons, we're going to be able to provide distributions early. We're targeting next week to provide the distributions. Thanks everybody for updating their ACH. We'll provide them via ACH, and we're going to be piloting monthly. So the way distribution is going to work, we're going to be providing a 9% preferred return on a monthly level. So annualized, so 9 divided by 12, a 0.75% return. Will be lag. We'll have a 2.5 month lag or 3 month lag every time until the end of the year, when we have a full year accounting and we're able to then true up the investors to hopefully a higher return number. Right now, we're still tracking everything good, but I just wanted to be conscious of the fact that we do have that media head iceberg potentially coming. Hopefully, we can steer around it in the next few months and prepare for that, and also smooth out some of the losses. The Airbnb was really useful because when you lock in tenants for 5 years, actually slightly above market rent, um, you don't have any of the repairs and maintenance. That doesn't cost us anything. They're repairing. They're taking care of all the repairs and maintenance. They're taking care of all the leasing turnover. So usually you have 5 to 7% economic vacancies just from leases turning over. Even though somebody might want to move in right away, it still takes a few days, a week at most, maybe 2 weeks to get somebody new into the door. So this just smooths everything out, gets us predictability, and I love predictability. Next slide, please. Let's go to some unpredictability. So development updates, and this is a slide that I had in our initial presentation deck. It's something that I highlighted a little bit, and I didn't necessarily, I didn't put into business plan. So it's something that we are still interested in, and Matt Huff and some of local builders are very interested in as well. So let me talk about 2 plans that we've been presented, and I want to present to the investors, and I'll summarize what we're thinking right now. Next slide, please. So I'm going to highlight the first plan is from Matt Huff and Huff Architects. They are, we looked at the zoning. We would probably need some additional zoning requirements, and most of it is going to be around neighborhood issues, the NIMBY factor. When you build up, people are going to either complain or they're going to be excited about it, but you just got to make sure you manage it from a political perspective. Next slide, please. So one of the Matthew Huff presented this plan to us, where they would essentially build up on both buildings and put these core vertical circulations, and this would preclude us from probably having any tenants during development. So that's something that I don't necessarily like. I don't necessarily like to not get cash flow when I can, and so that's why we're a bit hesitant to do this unless there's significant upside for our investors. Next slide, please. So the plan is to put 4 levels of micro units in these, and these are very tiny units, 282 square feet, 422 square feet. The target demographic are really people who love the park, people who see the park as their backyard. It's a very unique park-like setting. It's very close to downtown, and it has amazing trails as well. And it's a really uniquely positioned building because there's really very few buildings or any building around. Next slide, please. So if you look at it's very small. You probably could rent them each out for 400, no, not 400, $550, $600 to $1,000. If you provide all amenities, I think that could work. We've seen micro units work in other parts of Kansas City. Next slide, please. And that's another section of the building. That's how it looks on that side. Next slide. And that's how it looks for both. Next slide. So the big thing is that we would be building up on the buildings, and they're in a very uniquely positioned so that you essentially would have park views galore. You would have all glass exteriors, and And I took my drone and we got up to where we believe the height of the building would be. And you see on the right pictures, that's where, well, that's the view potentially from the top. It's a really cool view. You can see basically the top right building, top right picture, you see University of Kansas MU Medical. So it's actually pretty close to a medical hospital, learning university. So that's why we were potentially excited about it. The numbers are we're still working out. Um, I generally am not necessarily a fan of heightened risk unless there are some some significant benefits, and I wouldn't do this without the investors' go ahead as well. So there is a plan B though. Can next slide please? So plan B wouldn't necessarily be building on top of the buildings. Because if you build on top of the buildings, you would disrupt the tenants. You might preclude new tenants from moving in during that time, essentially limit us from having um, revenue. If all the entitlements were ready and we had everything planned out and everything ready now, I wouldn't mind doing it. It would. It's a really uniquely positioned asset. We own the building already, so some of the entitlement risk is gone from a land purchase perspective. But the second plan is to build these I would probably liken them to like shipping container modular buildings, um, that where we get connected to Aaron Schlego, who ran about $1 billion worth of development in Kansas City in the Midwest, and he's exploring his own startup, and he was looking to actually buy Grocers Warehouse by the time we were on the contract, and that's how we got connected. He was actually trying to make an offer at the same time our offer was accepted a few months earlier, and so one of the things that we're trying to look at was potentially building his concept in our parking lot. And so this would actually be much easier to sell. We wouldn't necessarily have to disrupt any tenants. So we could go ahead and lease the space, continue to lease the space, continue to generate revenue. And from the perspective of the investor, we could de-risk it for the investors, our investors, by potentially doing a land lease. So essentially just having additional revenue for the investors, and then decoupling the investment risks to potentially a new investment entity. Next slide, please. So this is really potentially a view of what it kind of looks like. It's 20 units, so much smaller. The other one was 80 units, and Centric actually designed something for 120 units. 20 units is much more feasible. Right now, we only have 14 units of multifamily, and to build multifamily like this and sell it, you probably sell it at a 5 cap, right? So this would compress the cap rate of our asset significantly, making it much more valuable. Um, and I calculated that this would probably only need around 300K of equity, additional equity, because a lot of it is equity from Grocers Warehouse providing them land, which we own already. It's not necessarily new, it's something that if you're building something, you would have to buy land, which we own already, and we would have to get architects and contractors and people to work on it, and that takes a significant amount of money as well. And they're willing on that side. Aaron Schlegel is willing to contribute that. This is a work in progress. I don't have a final decision on any of this yet. This would be a much more lean approach to creating some really good incremental value for our investors above and beyond the 12% we're tracking towards. But I want to be mindful that that wasn't necessarily the initial business plan that you guys invested in. uh, I would I wanted to highlight this opportunity because I want us to be partners and take your feedback. So feel free to reach out to me if you have any additional feedback on these investments. One thing that we could potentially do is essentially reserve some of the cash flow from the building and essentially build it without having to put in any incremental revenue equity into it. but that means we're not necessarily distributing cash flow to you guys, which we're planning to next month, next week. So I'm trying to find some additional alternative solutions. I'm going to fly to Kansas City in a week and look at some uh, other ways to de-risk it for our investors. Or potentially we just don't do it at all. And this was a good exercise to see the potential of Grocers Warehouse and sell it to the next investor with these plans in mind. So that's Grocers Warehouse update. Before I go to new deals, I want to see if anybody have any questions. I do have some new deals that Tozy Capital is working on. I don't necessarily, we're going to go through those really quick at the end, but I would like anybody to see if they want to ask questions and I can hopefully answer them. Or you can type in chat and I'll wait 15 seconds because we're going to try and make it as awkward as possible.
Well, it looks like all the attendees have talking permitted, so they just have to unmute if they have a question.
And feel free to type in chat as well.
Yeah.
While you guys think of questions or type in chat, I'm going to talk to some new deals. Next slide, please. So one thing that we have done since we closed on Grocers Warehouse is that we closed on Independence 3, a 426 unit apartment building, which I believe some of you guys have invested in as well. So thank you for continuing your trust with us. That one, we closed one of the buildings in early October, so last week. 2 weeks ago, a week and a half ago, and we're going to close the other 2 buildings in a week and a half. Another building that we are about to get under contract on, and so this is a preview of potentially that deal, and based on our initial underwriting, is Independence Towers. This is a different type of investment. This is a 10-year hold on a mostly strong cash flow deal that has less upside than potentially other deals because of its limited value add. Is a C-class asset, mid-rise building, and it's going to generate 12% cash and cash every year for 10 years. It's a strong coupon clipper, great tax advantage, and something that's going to be pretty, it's going to be really great for just a long-term cash flowing asset. I see we have some questions before we go to the next deal. We're going to ask and answer those questions. So Vamchi asks, would no stimulus from the Fed have impact on existing tenants? That's a great question. Impact in terms of rent collections. The PPP loan definitely helped the tenants, but those have since expired even when we acquired the asset. That occurred around April. We closed it on June. For the rest of the stimulus, which is more $600 a month, the multifamily side of things, everybody was paying on time, and everyone continues to pay on time. That's not necessarily the type of tenants that I worry about in terms of being able to pay. The businesses are really the big tenants that are most concerning. And as long as they have continued business and continued operations, I think we're fine. I'm very happy with supporting them any way I can, any way we can. Kansas City is definitely a different market than California. So for most of you guys are in California, it's very open. The last time I went out was in Kansas City, and before that, the last time I was out was in Kansas City. It's not like I'm going to Kansas City every week or month. It's just that it's just different feel than California. Whether that's a good or bad thing, I don't know. Gio asks, if you go ahead with the addition to the property, what is the rough timeline? So both opportunities would probably take less than a year. They would take around 8 to 10 months, with the bigger one being slightly longer, and the main part of it being the entitlements and the permitting. So with the 20 unit opportunity, you're looking at probably 4 months of entitlements and permitting, and then 6 months of construction. It's modular, so you're building it in factory offsite, in a factory outside premise. You just stacking it, stack it, and you put building it above a structure, the parking structure, so that you're not actually removing any parking, and it's going to be on the back, and so it's not going to be visible to the road, so you can have less people complaining about slightly views. I'm going to go to the next deal real quick. So Hampton Manor, um, this is a new deal that I'm working on as well, and it's a senior living facility, and I and I'm we might have another senior living facility as well that we're looking to get into. I'm flying this Friday to look at this deal. We're under contract, and this one is a really cool asset because it's not necessarily just a real estate play. It's a real estate and business investment. The highlight of the deal is that you get 1% monthly dividends for 5 years, with the option to keep it for 6 and 7 years, but you can be capitalized out at 5 years, 6 years, or 7 years. Um, and you get the same benefits of owning real estate. You get the depreciation, which could be 55 to 60% of your investment, and it's a preferred return model. While I say everything is going to be sort of 12%, I'm projecting 9% or 10%, and hopefully we're going to beat that. This is sort of, I can't say guarantee because that's not allowable in investment security, but this is sort of as you know finely tuned as possible. The reason why this model is able to exist is because we're buying it with the operators, and the operators are essentially providing us all the income to provide to the investors, and the operators for senior living usually have fairly high net income from it, and the operators themselves has around $400 million worth of assets, so they're recapitalizing on these assets, and they have a huge margin, and so they're just looking at this as a 12% preferred equity cost. So they look at like mezzanine debt, 12% debt cost, and we're providing essentially our investors a 1% monthly dividend. So it's going to be paid monthly, month one. So it's not going to have any lag time. It's going to be as predictable as possible. There's no necessary upside, however, that's the downside of this, but it will act like a high yield muni bond in a class asset that has very little risk because of the scale of the operator. The operator has hundreds of millions of dollars, and I'm very certain that he can pay. And we're writing a contract that is going to be very ironclad for our investors. But it's definitely more of a um, low risk investment that generates 1% monthly dividends. The other Independence Towers is we're operating an apartment building. I expect it to be 12% cash and cash as well, and that's going to be more dependent on how much rents we get and how much the repairs and maintenance and all that stuff. This is going to be as straight line as possible, very little deviation from it. Well, actually, no deviation from it. Next slide, just one more deal. This deal is something that we are in almost best and final on, and uh, I hesitated to even include this, but this is a B class build in Lansing Heights, it's in Kansas City area. It's a bit newer building, something that I don't necessarily like to buy because you don't generally have as much cash flow. In this case, it's only 8% cash flow, but it's a huge value add play because it's a light tech building. Light tech is sort of like Section 8. It has well, not Section 8. It's low income housing tax credit, which means you have to keep the rents at an artificially lower price point. But once those expire, which it expires next year, this year, and sort of a little blur between lines, we can then bring it up to rent. And so it's just a value add play. And so we're best in final. Hopefully we can get it by the next few days. So it's around a $14 million deal. The previous one was $15 million. The first Independence Towers was $7 million. So those are the new deals. I do have one more that I'm working on, but I also have a baby coming in December, so probably should wrap it up. Anyways, if anyone have any questions, I don't want to take too much of your time because we are recording this, and I'll provide people this information and this webinar recording. And if you guys have any thoughts or comments or any other things. I see a Q&A from somebody who asked about installing solar panels. One thing about solar panels is that I really like the concept. And I think for Independence Towers, another building that I showed, I would love to install solar panels. We can't act as a utility. So if the tenants are being sub-metered for electricity, for residential tenants in Grocery House, they are. In the commercial tenants, most of them are on triple net leases, which means that they're paying for the utilities themselves. So essentially, we're just providing extra value to them. And because we have the leases to lease, we're not renegotiating the lease and telling them, hey, we're going to give you free utilities now. You're not going to pay them. And you can help us pay for the solar installation. It would have been a great tax benefit. The ROI would have been around 25%. But if we're not able to pass that cost to the investors, I mean, not to the tenants, then it's not worthwhile. And that's kind of the major problem with installing commercial solar across any commercial building. And if you Google this is a very prevalent issue. And so for buildings where the tenants aren't paying utilities, it makes a ton of sense. And mostly that's multifamily where it's not sub-metered. So big buildings that have one roof, or self-storage is another thing, which I'm doing as well. So that those are kind of buildings where the tenants aren't necessarily paying the utilities. And if you can save on expense and make money on the tax credits, then that's a really great option. Any other questions? All right, guys, I really appreciate everyone attending on Sunday afternoon. Hopefully you guys enjoy the rest of your weekend. Thanks and have a good night.
Thanks, everyone.
So